Today we're deep diving Sampo, Finland's insurance giant, and why income investors keep it on their radar. Is Sampo a stable compounding machine, or are there risks most people miss? We'll cover the business model, the Mandatum spin-off, dividends, buybacks, and key risks, retail investor friendly. Sampo is primarily a Nordic property and casualty insurer, collecting premiums, paying claims, and targeting disciplined profits. The core is the Nordics, plus a UK digital insurance business. Investors care because Sampo has a long history of returning cash to shareholders. Sampo was founded in 1909, over a century of insurance history. Over decades, it expanded from a Finnish insurer into a wider Nordic group. Sampo explored broader finance in the past, but the long-term direction became clear: focus on insurance. If P&C became the powerhouse, the main earnings engine across the Nordics. Today, Sampo is much more streamlined, and that matters for dividends and capital returns. Sampo's main pieces are If in the Nordics, Topdanmark in Denmark, and Hastings in the UK. If matters because scale in insurance improves pricing, data, and efficiency, and that supports margins. Topdanmark strengthens Sampo in Denmark, adding premiums, customers, and potential synergy with If. The strategic idea is integration, simplifying structures and capturing efficiency gains over time. In the UK, Hastings is the digital-focused business, especially motor insurance, plus home insurance. Hastings gives Sampo exposure to a huge market and builds digital pricing and distribution capabilities. And importantly, Sampo is no longer the same banking and life conglomerate story it used to be. Mandatum was Sampo's life insurance and wealth management arm. Sampo chose to spin it off to simplify the group and focus on P&C insurance. Mandatum became a separate listed company. Shareholders received Mandatum shares. This matters because a cleaner structure often means a clearer valuation and fewer moving parts. After Mandatum, Sampo's identity is straightforward: a P&C insurance pure play. Insurance starts with premiums, customers pay up front. Then claims are paid out: accidents, damage, medical costs, business interruptions. And the company has expenses: staff, marketing, and administration. The key metric is the combined ratio, claims plus costs divided by premiums. If it's below 100%, the insurer makes an underwriting profit, before investment income. Insurers also invest the float, premiums held before claims are paid, often in bonds and other assets. People renew car and home insurance every year, which creates recurring revenue when managed well. Scale creates data advantages and lowers unit costs. Both are powerful in insurance. Sampo is diversified by geography and product lines, reducing dependence on one market. The big risk in insurance is underpricing. Strong insurers constantly adjust pricing to risk realities. Digital tools improve claims processing and pricing precision, helping efficiency and customer experience. Insurance is built on trust. Customers stay when service is reliable and claims are handled well. Mature insurers can generate strong cash flow, making them natural dividend payers. Sampo is known in the Nordics as a consistent shareholder return company. The company targets paying out a large share of operating earnings over time. The focus is not flashy growth, but stable and sustainable payouts aligned to profits. But dividends aren't guaranteed. They depend on earnings, capital buffers, and claim cycles. Buybacks reduce share count, giving remaining shareholders a larger ownership slice. Sampo uses buybacks to return excess capital when it's not needed for growth or solvency. Even if profits are flat, fewer shares can lift earnings per share over time. And it can support dividend per share, because the payout is spread across fewer shares. For Sampo investors, dividends and buybacks are two engines powering total return. If repair and medical costs rise faster than premiums, profitability gets squeezed. Storms and extreme weather can cause large claims, especially in property insurance. Competitive markets can trigger price wars, and that can destroy margins quickly. Insurance is heavily regulated. Capital requirements can influence payouts and strategy. The UK market is highly competitive, and motor insurance can swing between good and bad years. If and top-down integration has synergy potential, but execution risk is real. For insurers like Sampo, keep it simple: quality underwriting, shareholder payouts, and risk control. Ask what multiple you're paying for earnings, and whether it matches growth and stability. Insurers are also judged on book value, the net asset base backing the business. Dividend yield is your income today, but always assess sustainability. Combine dividends and buybacks to estimate total shareholder yield. Sampo is a Nordic P&C leader, strengthened in Denmark, with a UK digital growth angle. Mandatum spin-off simplified the story. Sampo is now a cleaner P&C insurance company. The investment thesis often comes down to shareholder returns backed by strong underwriting. And the risks are clear: claims inflation, catastrophe losses, and competitive pricing pressure. Would you buy Sampo for dividends and buybacks? Comment your view, subscribe for more European stock deep dives, and I'll see you in the next one.